Hello, and welcome to the Argyle CFO Leadership Forum, FP&A Innovation for Growth. My name is Nick with Argyle, and it's great to have everyone joining us today. I have some important information to share with you, and then we will turn the floor over to our esteemed opening keynote speaker. First, we would like to take a moment to thank today's sponsors, SAP, CCH Tagetik, and Lease Accelerator. Our sponsors are committed to providing you with valuable content and a great overall experience. At any time during today's event, you can visit their virtual booths from the main agenda page, which include complimentary materials, information, and meet and greet opportunities. We also welcome you to stay socially connected during today's event. For those of you who are active on social media, please use the hashtag ArgyleDigital and follow us at Argyle Exec Forum. Also, be sure to follow Argyle on LinkedIn for special announcements. I would like to take a moment to touch on our content neutrality policy, which we have curated based on the feedback we have received over the years from our members. We have worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. Finally, and most importantly, we want to hear from you. So during each session, we encourage you to submit your questions and comments in the Q&A box on your screen. Following each presentation, we have set aside time for our speakers to weigh in on your questions. Thank you again for joining us today. Now, let's get started. Without further ado, I would like to introduce Rena Kacker, FP&A Executive, Software as a Service, FinTech, and Life Sciences. We're super excited to have Rena for our opening keynote presentation titled Scenario Planning and Predictive Modeling. Welcome, Rena. Over to you.
Good morning, everyone. Thank you for the welcoming note, Nick. Happy to be here. FP&A is a broad subject in the space of the G&A functions. It works in partnership with accounting, treasury, investor relations, and the other G&A departments to ensure smooth operation of the company. So for those of you who might be new to FP&A, FP&A is basically the finance arm that primarily looks into the future, as opposed to accounting, which is always looking at what has happened in the past and accounting for the actuals. FP&A is looking into the future and trying to predict which way the financials, the company's key metrics, and customer satisfaction and other metrics are trending. So today, we can start with looking at what are the key areas that FP&A covers. This is a lot of words on the screen, but those of you who have been doing finance for a few years will identify with these. You are called to do budget versus actuals. You have to approve capital expenses. You have to support fundraise. You have to be a critical part of any hyper growth or downsizing. You are presenting materials to the PE investors, the VCs, shareholders. You are approving PRs every single day, working on SOX and auditors compliance issues. And on top of it, you're doing long-term planning and budgeting, forecasting. And most importantly, you are working closely with all your business partners to support their changing asks. So they might think they'll do one thing, but they might do something different. So in all of this, the common thread is you're trying to streamline a projection of the future and keep things in check. And that is where we are going to be diving into a few different topics today, comprising predictive modeling, scenario planning, and sensitivity analyses. This is a short, high-level presentation. A lot of the data that you see presented here is by nature very simplistic to drive home the point. In the real world, things are complex. So with that, let me go into what we're going to cover today. So scenario planning refers to what if. How would the company's projections and strategy be impacted if we did this and not that? If we chose option A versus option B, that could be launching different products or initiatives, different promotional campaigns. And then all of this ultimately impacts, based on these what if scenarios, how is it going to affect our overall corporate goals versus our cash runway? So I have prepared some simplistic scenarios. So what if you had a product A that is a subscription, software as a subscription product, let's say, costs $10,000 a year subscription, and it needs 2 years to be developed. It's going to cost $2 million, all expenses in. You have a product B, it's a $1,000 a year subscription. It's going to be developed in 9 months. It's a lower price point, and it costs less to develop. So the answer as to which strategy a company should choose depends on how they want to look into the future and what's important. So I threw together some numbers and drew some charts. I know finance doesn't go without charts. So as you can see in this simple assumed ramp of product A, which is our higher price point product, we said, okay, the cost is going to be 2 million, which is the solid red line in the middle of this chart. And then the volume is going to ramp up. In the beginning, there'll be no revenue. And then the blue revenue line wraps up. And the yellow line is the margins. So as you can see, the margins eventually break even in year 6. Of course, this will differ for every single project. But in this scenario, that's how it's situated. And then I drew out projections for product B. Here we said, okay, your cost is a solid at 1 million, the solid red line. The revenues are growing. As you can see, the revenues only break even. The margins only break even in year 9 because the revenues are low. It's a lower price point product. And even though you're selling many more units, if you look at the right side axis, the one in the hundreds, you're selling many more units because it's lower price point. You're getting more customers to adopt it, but it'll take you longer. So now if finance puts out these two charts, the executives can then ponder which is the right strategy. Do we want to conserve cash, have low cash outlay, and break even later, even though the product B might eventually become more profitable because it has a higher unit volume? Or do we want to go big now and do the product A? So this is the supporting information that FP&A would develop. And the answer would be, it depends. It depends. Where is the demand versus price? Is there a significantly high demand for the higher price point product or lower one? Is there price elasticity? How flexible are customers with paying a higher price? There are products that are price inelastic, means we will pay whatever we are asked to, such as when you file your taxes, you don't have much of a choice. And what's the long-term margin? And there's no right or wrong answer. But here's one example of scenario planning. And if we look back at the pandemic economy, you will recall that there were several big name companies that had their forecasts going through the roof. They were exceeding all their forecasts during the pandemic, Peloton, Zoom. And we have seen how they have trended in more recent times because the scenario has changed. And even if they had done a planning for a more modest future, you can never really tell how things will pan out. But the main purpose is that you get a certain view of how things might unfold instead of just having an anecdotal or a gut instinct about things. So that was product launches. Here is promotions. Similarly, you could graph out, should you give 20% off to new customers and expect that they'll all renew the following years at full price? Or should you give 50% off and start with an even lower margin with the assumption that they'll all keep renewing their subscriptions in the future? So with that, once again, the answer is it depends. If you can get a lot more customers at the lower price, then the lower margins of the first year will be offset by higher margins and higher income in the future. So you have to look at metrics such as customer acquisition, customer activation, and customer activity to determine how you want to position your promotions. And you have to look at churn. You don't want to give a huge discount only to find that at the end of year one, you had customers drop off. They did not renew. We're all familiar with, first 30 days, the price is this, then you can cancel at any time. So you have to be cautious. So this tool gives you the ability to look and quantify the impact of different scenarios. Corporate goals versus cash runway. This is another flavor of scenario planning. So you might be a company and you have 3 big initiatives to launch, and they all cost a significant amount of cash outlay. You have to hire folks, you have to buy some capital equipment, you have operating expenses, folks will travel, professional services, all of that. You could launch them all consecutively, or you could straddle them and start with initiative A, achieve success, and then bootstrap initiatives B and C with the earnings from initiative A. So that would be lower cash outlay. So here are some illustrative numbers. As you can see, I have cost 1, revenue 1, cost 2, revenue 2, cost 3, revenue 3. What these mean is basically by year, what will be the point in time when we'll start to see the revenue. As you can see, the revenue starts showing up in year 2 and year 3. The costs are front-end loaded. So if you look at the scenario where we want to launch all the initiatives at the same time, refer to the total cost line. And you can see in the first 3 years, we are spending 7, 8, 7, about 22 million in the first 3 years. Whereas the total revenue in the first 3 years is 0, 2, and 6, which is only 8 million. But over time, the revenue ramps up and the costs come down because the heavy lift of launch and go to market is taken care of in the first few years. And the cash outlay is the very bottom line, which tells you the cumulative cash that you would have spent, that you would be out of as you go on this path. So in year 3, you would be negative 14 million. And then after that, you start to turn favorable because you have revenue starts to ramp up. So the answer to what should you do in terms of launching consecutive initiatives versus one at a time, once again, is it depends. How critical and competition sensitive are these initiatives? Is this a certain area that you have a short time patent for that might expire? You want to jump on it all at the same time? Can you even resource? Do you have the talent and the technology and you can onboard it in order to really start these initiatives at the same time? And does your cash balance support this? Do you have enough cash outlay that when you reach that dip in the early years, you can afford it? And in the long term, will the revenue that you get by going in early offset the impact of these concurrent costs? So something to think about. The next topic that I was going to cover today was predictive modeling. You hear the word predictive analytics, predictive modeling, and machine learning, AI, and all of these are woven together, but at their basis, they are all trying to generate projections based on historicals. It could be as simple as a historical time series, or it could be a historical pattern of development of metrics. And I can tell you what I mean by that in a second. Or it could be regression, which is you're trying to fit in a line between data points that you have seen in the past. Or it could be neural networks, which is in its own space now. So I have created a view here where you could be in the market, in the e-commerce market, and you sell items, and some percentage of items come back for a refund. And then the refunds can have many reasons. They could be returns, they could be manufacturing defects, they could be fulfillment issues, items were received too late, or you may simply not like it. It could be customer satisfaction issue. So all of these patterns, or they could be items that never arrived. So all of these are events that will happen in the future. So the day that you sell your items, how can you project how much of this you should set aside for a refund? The answer to that is you have to look back and you have to look at the historical information to see how these have developed in the past. So, in the last 6 months or 1 year, what percentage of a certain month's sale has come back for a refund? What percentage of those refunds were described due to manufacturing defect? How many of them arrived late or arrived broken? How many of them were the size didn't match, the color wasn't right, it wasn't what I thought it would be? That would be a customer service issue. And what percentage of the historicals were not received at all? So, using those percentages, you can then make intelligent assumptions about the items that you're selling today. What percent will be refunded, and what the estimates are for the categories. And then it's very important that as you progress from month to month, you keep truing it up. This is what is called development patterns. So each cohort of sales, last month's sale, the prior month's sale, 3 months ago sales, they all are having actual refund patterns emerging with each passing month. And you use that historical data to not only project the future month's sales, but also to refine your projections of the refunds for the past month's sales. So it's like a development triangle where then you can come up with, oh, because of the novelty of this product, we are going to see higher refund demands because we are already seeing in the first 3 months the refund requests have been higher than what we saw for the products that are underlying our model. So in that space, you can then make a determination that you're going to basically make higher reserves. And when I say reserves, for those of you in accounting, you have to have reserves for things like refunds or bad debt. And that's where these models for predictive modeling come in. Predictive modeling is used in weather forecasts, it's used in insurance claims, transaction and fraud losses, it's used in customer behavior, and now AI is going to be playing a bigger part as we adopt AI to do a lot of this decision tree related work. So that's predictive modeling. So for today, I wanted to touch back on the areas that we covered and tie them back with the work that we do in FP&A. So in FP&A, we do budgets, forecasts, and long-range plans. These plans comprise the full breadth of the profit and loss statement, the P&L, income, COGS, operating expenses, margins, and each of those line items need projections. And we use a combination of these techniques that I described in projecting each of those P&L line items. Those then drive the balance sheet line items, and we use the cash projections based on our capital outlay to drive the cash flow statement. So these approaches are key to the 3 financial statements forecasting. Best use of cash on hand, especially for those of us who are on small to medium businesses, we are very aware of our cash runway and the sensitive to things that might offset it. So it's important that we do these scenarios in great detail and run sensitivities against it so that when the cash impact is likely to bring us to a risky point of dipping below our cash reserves, and we don't have enough time to go and do another fundraise, we can then try to re-steer our strategy to not put that much emphasis on burning cash up front. And this, in turn, helps us to build the organization we want to build. There are different mindsets. Some organizations are capital intensive, if it's space or other areas, and others can be bootstrapped. And what bootstrap means is you start out small and you use the proceeds from the early days to finance your future growth, and you're not dependent on big raises and lots of oversight from your investors. So those are the different ways you can run your organization. A big part of all of these approaches is headcount planning, and headcount is a very high capital item, and it is a very sensitive item around the organizations. So one has to always be cognizant that the headcounts that we strive to acquire are well supported by the capital and other needs they will need in order to be successful in launching their initiatives and executing their corporate goals. That was my presentation. I would be happy to take questions from the audience.
Great. Here's one from the audience. This one just came in, Rena. First of all, they said, thank you, Rena, for your insights. And here's the question. With the advent of increasingly pervasive Gen AI and AI, are you looking at use cases where you are leveraging Gen AI/AI to gain efficiencies and speed to decision and market?
Yes, that's a really good question, top of mind for everyone these days. There we have ability in most of the LLMs that are out there to feed data to it, and it can provide rudimentary forecasts. Folks have done it, but this is still very early stages for AI in general. And the models, there are so many out there, but we haven't seen any. I haven't seen any specific models that specialize in projections yet. But that's a good question. I think it'll be interesting to see how this whole AI launch pans out over the next 18 months to 2 years.
Great. Here's another question. What are the key considerations when selecting predictive modeling techniques for different financial scenarios?
That's a great question, and it depends on space to space. So let's take a few different spaces for consideration. If you are, for example, in life sciences or biotech, you are planning for many different scenarios. You are making decisions on, are you going to manufacture your drug product in-house, or are you going to outsource it to a contract manufacturer? And then based on the product that's manufactured, is it going to be acceptable in terms of its quality metrics or regulatory confirmation? Or there are other aspects to life sciences such as assays and methods, and is it going to qualify? All of those are scenarios that you need to plan for. What if a batch of product is no good? You have to invest in additional batches of product. What if there was an issue in the distribution channel? What if a certain product was basically corrupted in the sense that it went through an unacceptable environment in the process of going from the manufacturer to the clinic? So you have to adopt many different aspects of scenario planning in the biotech and life sciences space. As you design your clinical trials, there are many levers to toggle. On the other hand, on the software side, your biggest scenario planning aspect typically is the competition. Who else is doing what you are trying to do? What is their cost structure? What markets are they targeting? So your scenario planning comprises, what if we enter this market versus that? What if we release a beta product or a light version early? What if we give real customer support, white glove versus a bot? All of those scenarios can be sized using predictive analytics to advise us on the potential impact to our P&L.
Great. Here's another one. What are the essential components of a robust scenario planning framework?
That's a really good question. So, essential components is to first of all list out all the scenarios for the different levers, different metrics that are inputs into your financial model. Um, and then determine which of those scenarios will really move the needle, which are critical and which are not going to make a big dent. Um, Come up with ranges for these scenarios. So it could be, what if I start a clinical trial 3 months later? What if we started with 30% fewer subjects? What if we have 3 doses versus 5? What if we go into this geography instead of this other geography? What if some subjects don't take well to the trial? What are the implications? And all of those form the framework of the scenario planning. And basically, you should have a base model, which is your assumed base case metrics. And then you should add on the different scenarios, holding everything else constant. So you could say, if all else stays constant and we just change the number of subjects, or if all else stays constant and we just change the dosage, um, how does that affect the overall financial model? So it's complicated, and the important thing for us finance people to remember is all of this takes time. So it's very key that we prioritize this with our management before we go out spending 10 days building a model, which is all the bells and whistles and the pretty charts. So keep it simple, keep it nimble, and iterate on it in partnership with your leadership.
Great. And I think we have time for one more audience question. Here's one. How can FP&A teams ensure the accuracy and relevance of real-time data when making predictions?
That's a really good question. So real-time data is obviously these days, everything is calibrated. We have more data than we've ever had before. One of the things is to understand if this data is accurate. So once it has been vetted for accuracy, it passes the smell test, then this real-time data can be fed into the models, and to see if it aligns with the historical trends or if it's causing volatility, if it's looking more volatile. And typically, you have to look at macro drivers that might be causing changes in the real time data. For example, if there is a hurricane in the area, the sales will go down, and it's not something that's controllable. Or if there has been, for example, like a big event like the Olympics, then the hotel bookings will go up. So you have to look at the real time data and understand what are the macro drivers which could be driving some of the changes you see there. And once you've determined that it's not a one-off scenario and the real-time data is showing a consistent trend, then you can apply that trend to the ongoing forecast. Like I mentioned earlier, a lot of the pandemic companies looked at the real-time data during the pandemic and said, oh, we need 10 of all of these. We need all of these extra offerings to go hand in hand with our solutions that are flying off the shelves during this pandemic. And then when the pandemic is over, the real-time data has changed, and they have to look at other ways to streamline their business. So yeah, real-time data is very crucial.
Great. Well, thank you again, Rena, for an excellent keynote. And I want to thank everyone else for joining us today. This session, along with all of today's content, will be available on demand following the event. As a reminder, please be sure to check out the prizes and raffle rules section to see how you can earn points for the chance to win one of several prizes. Our next session will begin at 11:35 a.m. Eastern Time, which will be a panel discussion titled FP&A Talent, Cultivating a Culture of Learning. Please click the join button that will appear on your screen to be redirected to the next session, and we look forward to seeing you there.